People aren't investing in electrification and renewables because they think it's nice to do, or they'll get some sort of moral brownie points. It's because electricity is more efficient. It's because it can be scaled, and bluntly, it's cheaper.
Hello and welcome to this week's Tea Break. I'm Al-Enazi, and as always, I'm here with my co-host Yuri. Today, we're thrilled to be joined by Thomas Morris-Brown, portfolio specialist at Impax Asset Management, specialising in environmental investments. Thomas, how are you?
Very well. Thank you for having me today.
And what tea have you gone for?
I've gone for an Earl Grey, splash of milk. Not massively original, but it's one of the things that I like to have on a client roadshow.
I've gone for the traditional breakfast tea today because I'm thinking of Thomas's background, having studied English literature, I think, at Oxford University, amongst those ivory towers. And, when you were looking at those Jane Austen novels with these sophisticated tea drinking ceremonies, which are very much part of the culture.
I mean, you've got to be careful with Jane Austen, because sometimes tea drinking is just tea drinking, but sometimes it's a very detailed metaphor trying to puncture elaborate social rituals.
Well, that's what I love about it. And how is it in the asset management world? If somebody goes for a cup of herbal tea, would they be pilloried for not being one of these go-getters and having their espresso, their latte, something from the big global franchises which you send the juniors out for on the coffee run?
I mean, firstly, sending the juniors out for coffee is very much a pre-2008 thing. I don't think anyone's ever done that. We're long-term investors. So, the idea that we're dosed up on coffee and, buy, sell right now is probably a bit far from it. I think you're far more likely to see our portfolio managers and analysts having a chat over tea in the breakout room and taking a considered view about stocks than reacting to the latest Trump tweet.
That's very nice to hear, Tom. And when we're thinking of those institutions in the asset management and in the broader British business world, we're seeing the sad demise, obviously, of the UK High Street and the WH Smith selling off its branches, the Trumpian tariffs, the Liberation Day that we've heard so much hype about, the fiscal headroom for Rachel Reeves, is that getting higher or lower? You're looking at a lot of these issues when you're writing about UK investment, Ali. What sort of conclusions are you coming to?
Well, of course, you mentioned WH Smith stores will disappear from Britain's high street, as the company focuses, more on its more profitable travel hub business. But there's also concerns in the UK over its economic growth. The opinion piece we carried out this week from ARC Research, it concludes that allocating to sectors like energy, defence, technology or consumer stocks is much more important than allocating to countries like the UK, the US or China. What is your feeling on this, and what is the environmental perspective?
The UK market, which is a fascinating market, very big difference between the FTSE 100, which is all large multinationals, and the 250, which is much more domestic. So 75% of revenues in the FTSE 100 come from overseas. So, people get very excited about what does the latest economic news mean for the FTSE 100. Well, sometimes it's not as simple as that. Take something like Brexit. Brexit, pound fell. The markets did very well because of that revenue translation. It's worth making very clear what we mean by environmental markets. We're looking for companies that are enabling cleaner and more efficient delivery of basic needs. So that's things like power, water and food. Or we're looking for companies that are addressing environmental risks, things like climate change or pollution. If we get the right companies, so we have to be stock pickers first and foremost, but if we get companies that are harnessing those long-term trends, they should be able to outperform. For us, taking a global perspective is so important because, to your point about specific industries, the difference between, for example, a US tech company and a US utility company is much more stark than, say, a US tech company and a French or British tech company.
A lot of countries are going through changes of political direction. One of the most interesting is Germany, which we covered in an opinion piece from John Plassard at Marabot Group, he says that after decades of economic decline and underinvestment, a change in leadership will lead to revival in Germany's industrial fortunes, which could benefit the entire European continent. Is that a sentiment you agree with?
I mean, you're clearly seeing it play out in the markets. The announcement was, 500 billion, an overarching goal of climate neutrality, 100 billion of that allocated to the KTF, the Climate Transition Fund. And markets reacted very positively. Morgan Stanley thinks it'll add about 0.5% of growth. At the margin as well, what's good for us to see in the context of some of the sustainability blowback is that, this is an economic goal that has been linked to a sustainability ambition, and the two aren't necessarily unrelated. You need to address some other issues which Germany has. Its reliance on previously Russian gas, reducing the cost of energy. Those sorts of structural things are really what's going to drive stuff in the long term.
I love your coining the phrase, the sustainability blowback. And I know you've got a lot of hidden talents as a writer, because Tom wrote a piece for us as well, which we carried a few days ago, suggesting that despite Trump and his populist policies supporting the drill, baby drill mantra and relating green transition to the woke Democrats, that clean energy is a theme that will not go away, even under the current US administration. Are you sticking very much with that belief of yours?
The International Energy Agency, the IEA, thinks that by 2050, global energy demand is going to double. You can see it very clearly over time. GDP growth and energy demand, they go up together. So that's happening. This demand for clean energy, and this applies to all of our environmental markets, that's driven by economic need. It's driven by efficiency. People aren't investing in electrification and renewables because they think it's nice to do, or they'll get some sort of moral brownie points. It's because electricity is more efficient. It's because it can be scaled, and bluntly, it's cheaper. The costs of something like solar panels come down 90% in the last 10 years. Batteries are getting ever cheaper. Now to such a point that if you install a solar panel and a battery, that's much more cost efficient than a fossil fuel equivalent. But also there's other ways to play it. It's not just about buying renewable stocks. In the IEM portfolio, for example, what we call independent power producers, they make up less than 7% of the portfolio. One of the things we quite often have to explain to prospects and clients is that you're not just buying a bunch of wind farms here, you're buying companies that are investing in the grid, investing in battery storage, investing in things like geothermal, and this whole host of other solutions which are related to the clean energy opportunity.
I think we can hear from what Tom's saying that the way portfolio managers look at investments, that's going for a wholesale change as well, because until before Trump was elected, it was still all about interest rates and earnings, but now energy demand and supply is really one of the key areas of focus for chief investment officers and portfolio managers. Ali, you had a nice trip to Paris recently, strolling down the Champs-Élysées, and you even dropped in to see the chief investment officer of Indosuez Wealth Management. He talked about defense, energy and infrastructure in that article that you wrote for us this week. What was the key message there for investors?
Alexander Drabowicz, Chief Investment Officer at Indosuez Wealth Management, he says Europe's economic transformation is underway. He highlights growing optimism, but earnings growth lags behind US stocks still. With protectionist policies, deglobalization, movement towards a multipolar world, does this also mean a movement to multipolar portfolios dedicated more by geopolitics than traditional market dynamics?
Geopolitics has always been important for portfolios. It's just that it has played out in the background or over the long term. So a book I only shamefully got around to reading recently is Chip War, the book about semiconductors and how it's all how that supply chain has evolved. And what becomes very clear reading that is that the US's campaigns in Vietnam, its attempts to fight the Cold War, those all were crucial to the development of companies like Texas Instruments, Taiwan's attempts to become economically independent, but make sure that the US was going to keep defending it. That's driven the rise of TSMC and what Morris Chang did there. Japan, likewise, investing its semiconductor industry to almost from a sort of nationalist perspective. What's happened now is that we have a situation where the news is much more immediate. We have a president who is perhaps not afraid of being a bit more unpredictable and taking a kind of, well, I'm going to do what I want to do, and if the market reacts, then I'll think about how I respond to it. The question really, which you put to me, was how do we manage that and incorporate that into portfolios? When you're a stock picker, the first thing is to identify the right companies, make sure you've got businesses which have the pricing power or operating in a niche where even if they do have to pass on costs, they can do so because their customers need their product. So that's step one. The second is engaging with the companies repeatedly, asking them what they're thinking, because at the end of the day, they're the ones that are going to have to manage this. The dilemma with, do the manufacturers pass on the costs? Do they absorb it themselves? Do they reroute their supply chains? So it's not as simple as going tariff X. It's a multi-layered discussion. And then the third thing that we can do as portfolio managers is look at the portfolio as a whole, understand the potential, simulations, if X, then Y, and respond quickly. It's not a case for predicting the future. No one can do that. But you can work out what's likely to happen, and when it does, react accordingly. And I think that's what's important.
A very nice summary of the tariff situation. And you mentioned the chip wars earlier on. And of course, we have our own chip wars in West London with the chip shops of Ealing, Acton and Southall. Do you still call them chips, Ali, or does the younger generation, are you slightly more Americanized calling them fries these
No,
days?
I still go for the chips coin. I mean,
I'm glad to hear it.
And Hanslow has the best chips. And
Hanslow has the
best chips.
Controversial.
But Thomas, thank you so much for joining us.
No, pleasure. Thank you.
Unfortunately, that's all we have time for. Thank you for watching this week's Tea Break. Make sure you watch our weekly Tea Break either on the PWM website or the YouTube channel. Thanks and goodbye.